So we got a good panel to kind of have an open discussion here about how alternative data can be used in the credit issuance process. We got a great panel of guys. Most of these guys I've known for years. There's a whole lot of experience in this industry at this table, so it'll be interesting to hear what everybody has to say. Why don't we start by having everybody introduce themselves. Steve, I'll let you start down there on the end.
Thanks. Hi, I'm Steve Ely. I'm the CEO of eCredable. We are a young credit bureau based here in Atlanta that works directly with consumers to help them build credit based upon everyday bills they pay, like rent, utilities, and insurance.
I'm Mike Mondelli. I'm with TransUnion now. Prior to that, I was the founder and CEO of L2C, which was a credit reporting agency that took data that was incremental to the credit bureau, trade line data, and created credit scores out of it.
My name is Rable. I'm the CEO of FactorTrust, and we're an alternative credit bureau as well, and been doing this about 10 years or so, working in short-term lending, installment lending, subprime card, pretty much anything that cuts across the underbanked consumer markets.
My name is Chris Hobday. I'm a VP at Equifax. We're a global insights company. Really got our start in alternative data maybe 25 years ago, evolving out of our traditional credit bureau roots.
And I'm Paul Mangelsdorf, and if you had to guess who was the only banker on the panel, and I run modeling and analytics for our consumer bank.
So to kick it off, there's been a ton of change over the past few years in just what the CFPB is requiring relative to scoring people that you're issuing credit products to. And you know, all of us that have been in the industry forever, there's only so much data that sits in the bureaus relative to these individuals. If you've never been extended credit, they don't have a lot of data on you. So you have to find all kinds of alternative ways to do that. So in this panel, we hope to discuss kind of the products that are driving that, the regulation that's driving that, and at the end of the day, the analytics and the end use cases are actually helping fulfill that need. Thought it'd be great to have Greg kind of start us off, just what's going on from a regulatory environment. He's deep in it as the CEO of FactorTrust, and we'll let him take it from here.
Sure, okay. So there's a lot going on, I guess, is the short answer, but the CFPB is doing a lot right now. There's a small dollar lending rule proposal that's out, that comments are due October 7th. And really, if you sort of look at that rule and what that's going to mean, it's really focused on kind of a couple of different areas. One is any financial product that's 45 days or less would fall under this sort of covered loan definition, as well as products that are over 45 days that have either a greater than 36% APR, have some connection to the bank account or the income of the consumer to be able to process repayment on, or have basically an auto title, so where you're using the car as collateral against the loan product. And then it involves some other sort of longer term loans with balloon payments, but the primary focus is in on the sort of 45-day and under products, and then the 45-day and over that are higher APR type products. So the big focus around that is really looking at ability to repay. And I think most people that have been in financial services for a long time know ability to repay in itself is not a new concept, but I think the way in which they're approaching it for these types of products is kind of adds another level of complexity to maybe what everybody historically has looked at there. So within that, they're requiring things like verifying and or validating different pieces of data, the consumer's income, their monthly expenses, not only what they currently have today, but a forecast of what they might have in the future. Looking at both alternative trade lines, alternative credit obligations, as well as other kind of major financial credit obligations, and ultimately being able to do the math to come up with what the residual income is for that consumer. And so this rule will basically put in place the fact that if you lend money to a consumer after you've done this calculation and your sort of look back of the period that you have to, if that consumer is perceived to not have an ability to repay that product, then that will become, an issue for you going forward as a lender. So there's a lot to it. It's 1,300 and change pages long. So we're all still in the process of digesting it and doing comments on it and that type of thing. If you sort of look at the timeline, based on sort of our best estimate, comments are due in October. We think it'd probably take at least a year to come out with a final rule based on the comments. And then there's a 15-month implementation period that's been communicated. So really the earliest we think something will be out there and a rule will be implemented is probably Q1 of 2019. So it's still a ways off, but there's a lot to do between now and then if you're a lender in any of those markets to be able to sort of live in this world.
And the net of it, it's good for the industry. I mean, it sounds kind of funny having a bill named ability to repay, but being in it a long time, I mean, people will absolutely tell you they didn't care if you repaid because they made so much on the fees on some of these short-term loans. So that concept needs to go away. Is people, you need to be able to issue credit and products to people knowing that they can actually repay them. And as a result of that, there's a whole body of work that's got to be done that requires data that we haven't had before. That kind of leads into Paul. Paul, you guys have a number of products at SunTrust. And we were talking before this, 10 years ago, what the products look like and what they look like today, what the problems look like and what they look like today. And so talk to us a little bit about those.
Well, we've actually been looking at this kind of data right now for a couple of different uses. One of the places that we want to use it is, if you think about the lending process, there are, at the first end, you need to authenticate that you really have the borrower you think you have, that it's not someone who's come in and is trying to defraud you. And then secondarily, you need to determine whether or not that borrower has the ability to repay, but also whether or not they have the willingness or likelihood of repaying. And so I'll hit the first one, since that's normally where we go in the process. And the place we're actually looking right now to see whether we can use this data is we have an online lending company. That's actually not technically a company. It's just SunTrust doing business as Lightstream. And we're one of the major online lenders in the country. We make unsecured installment loans over the internet. And the credit risk is not an issue for us. We've got models that we can, and credit rules and all sorts of things. And so we've got very good credit performance. But what we do worry about is, since we're never actually seeing this customer, is this really, if you come to me and say, you're John Smith and you live at 123 Elm Street, then I want to make sure that, and I get Social Security and John Smith, and I pull it up on the credit bureau and I see, here's John Smith and all this and other stuff ties together. I need to make sure that you are in fact, but I see something that says, John Smith, I've got another address over here that's showing up. And one really good way to see it, if I go out and find that same John Smith has been paying electric bills and cable bills and phone bills at 567 Main Street in the next town over, then maybe what that means is I don't really have John Smith. I've got someone who has taken some of their information and has sort of created and so we're looking for, we have lots of layers of authentication, and so we're looking for this as important authentication. Any source of data we can get to help authenticate is just a wonderful thing. The second place, of course, where it really is really helpful is younger people in particular, or people who are, for whatever reason, are just entering the credit market. How do I know to make a car loan or a credit card to someone who doesn't really have any any credit on the credit bureau? I pull one of the lovely bureaus from my friends here at TransUnion or at Equifax, and it says, oh yeah, they've got a Macy's card for $200, and that's it. Or they've got a Macy's card and a $1,000 credit card. And they've had it for a year and a half, and they've got a reasonable job, and they've paid those. But how do I? I'm about to make I want to make a $15,000 used car loan for them. And today what I do is I turn them down. It's a thin file. I don't have enough data. I'm sorry, I can't make that loan. But if, on the other hand, I can go out and get this alternative data, the utility data and say, oh, look, they've lived for the past 2 years and they've paid their electric bill every month regularly. They've paid their cell phone bill. Of course, if they're young, they're naturally going to pay their cell phone bill. And, that is, of course, if they're not on their parents' plan. I'm still paying for my son's. And he just got married 2 weeks ago. But if they're paying those, okay, then, maybe I can make a different decision. And so it's a way for people who, also, people who are sort of low and moderate income who may not be able to be into the credit market yet. It's a way for me to get information that would allow me to extend credit where I otherwise wouldn't. And so, every time we come up with a new source of data, we want to find ways to use it. And those are a couple of ways we've thought about. I thought of one while we were talking here, about the ability to repay. There are some of our higher end products where we're doing a really more complete debt service and capacity to repay, where we're trying to see how much excess cash flow they have at the end. But we're estimating what we think their utility bills will be for that purpose. And it just sort of suddenly occurred to me, I don't need to estimate that anymore. I can go get it. Yes.
That's great. Yeah, it's a whole different set of problems and challenges than you had 10 years ago. And if you listen to it, it's e-commerce driven, right? Somebody walks into your bank, they're getting a loan.
And
Well,
I got their driver's license on it.
you're staring at them.
Yeah.
Versus
It's
you're
not the
sitting
same
behind a
if-
computer and they're in
They're
Russia
tel-
somewhere pounding on you, trying to get a loan.
Yep.
So it's a big problem. Kind of moving on from now that we talked about the regulation that drove it and all the products that are out there that meet the need, have the need, we get to the geeky part of how do we meet that need with data and analytics. And I was part of the data analytic business years ago that I was fortunate enough to work with some people in this room, and I can tell you 10 years later, it's been 10 years, longer than that, it's crazy how much it's changed. I mean, it is a ton of data, a lot of varying analytics, and why don't we have Chris and Steve tell us a little bit about what type of data is out there that can be used to solve these problems, and then what are some of the concerns you're seeing?
Yeah, I think one of the nice things about needing alternative data today is that there's a lot of it out there, right? You have a number of really excellent companies here at this table. Whether you're a credit bureau or you're a thermostat company, it's just kind of table stakes at this point that you're gathering as much data as you can and you're trying to find ways to make it available. So rather than trying to catalog all the different types of alternative data that you have access to today, right, I think there's some key themes that we need to consider when we're looking at how do we use this data in our businesses, right? And I think of it in really three parts, many things we could talk about, but the first is regulatory, whether that's from a government entity or from your contributor community itself. You think about coverage, which would be how much of the data is out there, right? And how much does the vendor that you're engaging with actually have, right? And the third is around freshness of data, meaning if you have a snapshot in time, how fast is your consumer behavior changing? How often do you need to measure that activity to give you accurate results, right? Just to back up and talk about the regulatory piece real quick, certainly we've talked at length about the CFPB. Greg walked us through one particular regulation that's coming up. Some of the things that we tend to not think about, or maybe that are emerging thoughts around alternative data, is the other types of restrictions that are placed on the data that we're considering using. For instance, as we get further into these alternative sources of data, there's questions of who actually owns that data, right? Probably it's coming from a non-traditional population of contributors. What are the restrictions that they're putting on us as your vendors of alternative data? What is our capability as your vendor to manage those populations, to make sure that the data uses are broad enough that you can drive profitable decisions in your businesses, right? Those are some of the key themes that we think about at Equifax around as alternative data becomes more and more to the forefront and more broadly used in solutions.
Steve, what do you have to add to that?
Yeah, I'll add a different perspective. We're a credit bureau, but we're a consumer-facing credit bureau. We don't aggregate data the way that Equifax, TU, and Experian do. We work directly with the consumer and act as their agent to get their permission to acquire how they pay bills and pay the rent and childcare and alimony and health club memberships, you name it. There's all kinds of alternative data. There's more than you could probably get your hands on. But we use all that data and run it through our scoring model, which allows a lender to use our score to assess the risk of that consumer, even if they don't have a traditional credit score. So that's the approach that we've taken. Now, we're not trying to be a credit bureau in the sense of let's house the data, keep the data, and own the data. We're trying to help this consumer cross the credit chasm. We're dealing with the 20% of the population who is a no-file, thin-file consumer who would love to be able to get a car loan or credit card from SunTrust but can't. And so we're trying to enable that consumer to do that. Once they do that, they have a credit card from SunTrust. SunTrust reports to you, Equifax, and Experian every month. Now they've got a credit file. Now they can start focusing on their credit file. But in our world, the way that our scoring model works, like any other good scoring model, we rank order the value of everything in the scoring model. Rent is really super valuable in our scoring model. Utilities is the second most valuable thing, followed by insurance, followed by childcare. And so we want to get the utility data because it's critical to helping our customer demonstrate their credit worthiness, and that's why we're working with UrgentNet because we can automate that. But we're going after things like cell phone, landline, gas, water, power, internet, cable, satellite. Those are bills that a lot of us pay every single month. And if you can get enough data, then that gives you enough information to drive a scoring model. All these scoring models are kind of built around, you got to have some content, you got to have some volume. You can't score people if there's no data there or limited amount of data there. And so you just got to get enough in there to make those decisions. And so that's what we're working on. But again, we're directly facing the consumer, trying to get our message in front of the consumer and solicit them to come join eCredable and help them help themselves. And that's what we're trying to do. And then once they help themselves, they help these guys.
And you're going to see this as a really important service everywhere. I mean, the last thing a financial institution wants to do is turn somebody down, but when they do, at least to be able to lend a hand and say, hey, here's a way you can go build that, you can build that credit base for yourself. You know, take advantage of the fact that you're paying bills and start to build a credit report or some credit histories. So data is one thing, but then you've got the analytic models that really bring all the data to life that actually results in a decision to authenticate somebody and let them in your door or actually extend credit to them. Mike, why don't you talk a little bit about what's going on the analytics side? And,
Sure. So, well, I think the utility data is an interesting data set. And it fits well with our model, both the legacy L2C model and the TransUnion model. I think the population that you're targeting is a little broader than just the underbanked or what's, quote, defined as underbanked, or maybe the definition of underbanked is broader than maybe some people traditionally think. It's not just people that don't have an established file or no file at all. It's really anybody that's below a 700 FICO, because when you get below that, the traditional credit bureau data starts to break down or gets non-discriminatory in its ability to score people very, very accurately. And so what we've seen at TransUnion is we've taken alternative data, which was in the L2C organization, and combined it with trended credit bureau data. And that would be things like payment amounts. So for instance, most people think that if you pay your credit card, it might show that you paid $1,000 towards your balance on the credit report. It historically has not. It's either just said you did pay or you didn't pay. Well, what we've done at TransUnion is we've incorporated the fact that you actually paid $1,000 and your minimum payment might have been $50 or it might have been $100. And so that gap there really provides a lot of insight into that consumer's ability to pay and their willingness to pay. And Paul touched on it earlier. You know, I don't think what we're trying to predict with alternative data is any different than what historically we've been trying to predict with traditional credit bureau data. It's really three things. It's really, will the consumer, if they have cash, pay you, their character? Will they, do they have cash? Do they have the ability to pay you, so their capacity? And then do they have the ability to get assets to turn them into cash if they needed to? So collateral. And so those are still the three things we're trying to predict. And you know, our methodology is to own as much of the data as we can, but where we don't own the data, to flesh out the picture, because as Steve said, the gap or the challenge that you have in applying analytics to this data is if you don't have data available, it's hard to provide a consistent score over the entire population. And so we think utility data does a variety of different things. First of all, I would say there might be a fourth pillar to it, which is stability, and we've talked a little bit about it. I just think it depends upon logistically where you incorporate it into your workflow. But knowing the consumer is who they say they are is extremely important. But even beyond that, being able to verify that they're at the same residence for a long period of time, they've had the same cell phone for a long period of time, and they've been paying utilities at the same residence for a long period of time, gives you a lot of insight and confidence that that consumer is a worthy candidate for a loan. And then you add in the other data sets that speak to their ability to repay and their willingness to repay. and you really can formulate a score. We've been able to create a score now that incorporates a lot of alternative data and Trinity Credit Bureau data that can be generated on over 250 million U.S. consumers. And so, I've been in this business since 2000. The term alternative data, I don't know if it'll ever go away, but this data has been out there a long time. And I think the credit bureau data, while very powerful and very good, has always been very limited. And I just think you're not going to do business with just that data anymore. So finding unique sources of reliable data with good coverage and clean data is what the industry is moving to.
That you can acquire at scale.
That you have
really
to
what
be
these
able to
guys
acquire
bring
at
is the
scale,
ability to
yeah.
get that data and have a scalable way to get that data.
Yeah, absolutely.
So you mentioned 700 FICO score. Just curious, what percent for the audience? What percentage of scores are below 700 these
About
days?
60.
Wow. So that tells you. So you're basically saying 60% of the credit people going to be scored need some data beyond what's in that credit report to make it.
What I would say is their scores will be aided in accuracy by having data beyond just the credit bureau.
Wow.
Right now, it would aid all the way up higher than that. But the problem for a lender is you can't change the pricing terms because they'll go to somewhere else.
Right.
So they can't get a return on that
Yeah.
data.
Huh. That's a data point I didn't
But
understand.
you could on a lower FICO score, because whereas you might make the loan, you'd charge a higher price because they have that lower FICO score.
Right.
But if you had the alternative data and said, actually, these guys are better
They look.
than they look at
Yeah.
that FICO score, then you could offer them a better price and get more volume there. So
Right.
That's an eye opener to me because we think about the underbanked as a limited population, although sizable. To think that 60% of credit issuance or credit or consumers' ability to get credit or authenticated could be aided by alternative data is a big number.
Well,
Has that gone up over the years or down? Is it about the way it's always been?
Yeah, I think the challenge is this: the credit bureaus historically weren't necessarily in the alternative data game as heavy as a just solo or a mono alternative data bureau was, right?
Right.
So when I used to talk to TransUnion or when Greg talks to Equifax or those guys, I think I fight this mindset inside of TransUnion all the time, right? They want to say alternative data is great for the no hits and the thin files.
Right.
The reality
Which
of
is
the
what I thought.
The reality of the situation is most lenders don't extend loans to the no hits and the thin files. Even if they have alternative data, that's not their target audience.
Right.
Their target audience is the rest of America. What people don't understand is the rest of America generally has below a 700 FICO score.
Right.
And so having this alternative data gives people that are paying their bills, whether it's rent, whether it's utility, the opportunity to have a better priced loan than they would otherwise just relying on traditional credit bureau data.
Sanjay,
I don't
this
think
is
it's
good news. You can
changed.
send a lot more data out there. That's a big statement. I'm a little naive. I did not know that. I'm in the camp of thinking it was mostly for benefiting no hits and thin files. That's good. That's good to know. So now that we've been through all that, so Greg, why don't you kind of wrap it up here for us? Where's all this headed? What's the future look like relative to the products and services you guys are providing from a data and analytics perspective?
Yeah, so I think, it's interesting if you look at, I totally agree with what Mike just said, because I think that's the part that I think people have always struggled to understand is where the value is. I think, if you look at the marketplace and you look at what's going on in financial services and that type of thing, it's interesting to me because in the last, call it 6, 7, 8 years, there's been tons and tons of innovation, and it's in, no offense to anybody that works for a bank, but it's in the non-bank type world, right? Mm-hmm. That's where most of the innovation is. And so I think that will continue, and I think it'll continue because there'll be more and more data that is kind of discovered and brought into the underwriting process or the marketing process and that type of thing. And I do think people will look more and more at opportunities where, there's 50 million underbanked, right? But there's 113 million U.S. adults that have a 700 or under FICO score. Mm-hmm. And some of those can go up, some of them will go down, but it's...
You can enhance it in some way.
Yeah, absolutely. Yeah. And so to me, if you look more and more at companies that are out there today, There's this big near prime push with, a lot of the fintech lenders. But, in the big scheme of things, those guys aren't doing anything new compared to what people were doing 10 years ago in the online kind of lending world. They have bigger marketing budgets. And so from that standpoint, I think that's a dynamic that I think will continue. We see products in rent-to-own, point-of-sale finance. It seems like subprime cards are kind of making a push again. There's just lots and lots of new areas that I think are really interesting, and I think give us a lot of opportunity. And I'm a big believer in you have to have the data. To me, it's you put a lot of smart people in a room and you give them all a set of data, they're going to come up with something fairly similar. I think this stuff you have to introduce a new ingredient.
Yeah.
And to me, the new ingredient is what people want to see. So it's utility data, it's trade lines that aren't reported to the big three, it's, pick something else. That's what people, I think, need to really have kind of more change and more opportunity in the area. And I think, the good thing is, there's regulation out there. Regulation will make lenders better, will make lenders be more creative, will make them do things maybe the right way where maybe some haven't been. But ultimately, when it's all said and done, I think the biggest winner is the consumer. Because, guys that were in 500 FICOs, nobody would touch them, right? And now you can go a lot of different places. And once the CFPB regulation comes in, I think the whole sort of credit spectrum will shift upward. So, the guys that are in that top 25% of scores, they'll go from having limited options to a lot of options. And so I think it's good for the consumer.
We'll have a nearer prime category.
I think so.
I always laugh when in bad times we call it near prime, and in bad times we call it subprime, and good times we call it near prime. We're calling it near prime right now.
Almost prime.
Almost prime. It's been funny. You can correlate that a little bit. So, let's take a few minutes for questions here from the audience.
There's technology solutions today that are trying to connect a series of data sources from multiple countries, particularly those that have high immigrant populations. So you think China, India, Mexico, into the U.S., and they're trying to make it reciprocal. So that's a technology solution. The other solution is, I think historically with L2C, the data we aggregated, there was a lot of information around establishing checking accounts and club relationships. And as those things get established, they're generally precursors to establishing traditional trade lines, but they get you into the data set. And I would think Steve's got probably ways people can come to their site and do that as well, right?
We have a proposal in front of a bank right now that deals with a lot of customers that immigrate from Mexico, professional consumers that come from Mexico, and they want to figure out a way to go back and get their bills from Mexico and use that in a model that they can underwrite here in the United States. So that's another way to try to skin that cat.
Any other?
So, Paul, you guys seem to suggest it would be helpful to use this type of alternative data that we've been talking about. What are the inhibitors? Why is this data not being used more broadly now? And maybe the answer is different for the online lenders than the traditional banks, but what would it take for the industry to begin to use more and more of this data that we've been talking about?
Mostly it's just sort of the inertia. We've got the traditional credit bureau data. We're finding enough to lend. Yeah, well, yeah, that's all good. I have to go through my, third-party risk management process with a new vendor and all the regulatory requirements around that, and then I've got to spend time hooking it up. I think it's more a question of inertia, if that data were right there and we could easily pipe it in, I bet you people start using it. And I think you'll see that there's a movement towards that. Banks are seeing lots of volume, or feeling like volume is going out the door through the various providers over the internet, the fintech firms, and we'll find new ways to do it. we've just been a little slow because of the natural, look, we've got this tool, it works for 60% of the people or 50% of the people, and we're able to, yeah. I mean, it works really well for 40% of the people, and then there's probably another 20% that it works pretty well. They might not be priced as well as all of them as they might be, but yeah, we haven't had the incentive yet, but I think with the current market, things are starting to shift and people.
Yeah, I'd say there's a couple of things, at least at Equifax, that we weren't doing well enough to enable folks like SunTrust to consume the alternative data we had. Right, first was we didn't have a system internally that had enough compute power and space to bring those alternative data sources together to help draw the insights that SunTrust would need. Right, so we made a massive investment in an environment that does just that. Right, the other thing is we also made it really difficult to connect with this data source within Equifax's walls, and then this one all separately. And so that's another place where we've tried to make advances, really bringing that all together, a seamless experience, a single front door. And we're hoping that those investments will make it easier to kind of bring in this new wave of data.
Yeah, I mean, I think that's an excellent point. I mean, because in some of our businesses, we're trying to make that decision in about 3 seconds. And, if we have to go get some other source and bring it in and it's slower, and then we've got to merge it and figure out, it's like,
It's going to be a no.
yeah. In fact, that's okay, fine, I'll just keep using this.
Yeah.